Good morning, this is Chartbusters. It's looking good for the markets in the first hour, but ahead of festive season, you and I go shopping. The most important thing now is Flipkart itself has gone shopping. I'm Manglam Malu, with me is Nigel D'Souza, and we take forward the Flipkart story itself. Flipkart has invested close to around 1,500 crores in Aditya Birla Fashion. Remember, Flipkart's owned by Walmart, so in effect, it is Walmart who has invested. Who told us first? It was Nisha Poddar, and she joins us for all the details. Nisha.
Thanks so much for that, Manglam. Yes, we had got a whiff of this kind of a collaboration because Aditya Birla Fashion retail was really lacking in the online presence, and that's why they had been for the past several months in the COVID times been talking to several of these big giants. It only makes sense because remember, Amazon had also bought 5% stake in Shoppers Stop. Reliance Retail has also been increasing its funds and also becoming a very formidable player. So to counter that, you need collaboration. So that's exactly what Aditya Birla Group has done, as it has been already given on the exchanges. 7.8% stake in Aditya Birla Fashion Retail will be bought by Flipkart for 1,500 crore rupees. And they've also given some more details on the arrangement when it comes to the sale of Aditya Birla Fashion Retail's brands on the Flipkart given platforms. So that will be an important aspect to watch out for. They have said that the distribution of various brand arrangements provides for preemption rights and also right of first refusal for 1 to 5 years. This will require some explanation, Mangla.
Okay, all right. Thanks so much for that, Nisha. Congratulations on yet another news break. Well, let's move on then and let's shift to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Saha of moneycontrol.com joins us to talk about a stock that he's tracking very, very closely. Anubhav, over to you.
Well, today we are talking about Vidhi Specialty, which is a food color company and caters to defensive end markets like FMCG and pharma. As it deals with consumption items, this space is highly regulated and there are limited players in this segment. Now, what got us interested in this clip is the change in business model, wherein company has been trying to reduce reliance on traded goods. So if you look at last 4 years, company has been able to reduce its traded sales contribution from 45% to 15%. In the meantime, company pursued debottlenecking initiatives, which helped in about 50% increase in production volumes. Now, impact of these changes we're also seeing for operating margin, which is up about 700 bps in last 4 years. Having said that, what makes it a stock to watch is CapEx plan worth 90 CR, which will increase capacity from 3,600 tons to 9,000 tons. This expansion is being done at 2 locations, one at Dahej and second at Roha. For the Dahej plant, EC is likely in the immediate future, and then it will take about approximately 15 to 20 months for the plant to get commissioned. In this context, we find balance sheet has sufficient headroom. Now, key risk for the company is dependence on China, from where it sources about 55% of raw material. Having said, company is pursuing few backward integration projects. Now, coming to valuation, even after recent run-up, there is further scope for re-rating as capex execution unfolds. Hence, we believe investors with high risk appetite can consider this export-oriented opportunity.
All right, thanks a lot, Anubhav, for that. That's about Vidhi Specialty, ideas for profit coming in from Money Control Pro. Meanwhile, just keep an eye out on the market. The Nifty holding at around that 11,950 mark. Remember, it's been facing a fair amount of resistance above that 12,000 mark thrice in the last 2 weeks. Let's see whether it goes up today and sustains above that or not. Because as there is resistance at the top, there is also a fair amount of support coming in at that 11,800 mark. And today, what's doing well for the markets is the fact that the auto pack is doing well. And alongside that, we have the Nifty Bank, which is slightly underperforming. So let's see whether that puts its leg up and moves ahead as far as the markets are concerned.
Well, let's get straight then, Manglam, to our first management. We have Mr. Nitin Rakesh, the CEO and MD at Emphasis, who joins us now. Hi, Nitin. Thanks so much for joining in. Always a pleasure talking to you. Well, give us a sense in the part of the business that did well in the past quarter. That's the direct core business. You know, the growth over there was very, very strong. Was it the large clients, the erstwhile clients, is it new clients, or is it the Blackstone portfolio that really fired for you? Give us a sense out there.
Sure. Thank you for having me. So I think on the direct side, the performance is actually quite broad-based. There are 4 or 5 drivers of growth that consistently have given us good revenue growth. Firstly, this was a record TCV win quarter in the direct channel. So clearly that's, a third quarter of 200 million plus net new TCV wins. This was a 360 million a quarter, highest ever that we've ever done. So I think that momentum of deal wins is translating into revenue growth. We are seeing good growth from existing large strategic accounts. We've consolidated our position despite all the vendor rationalization efforts and everything around, consolidation that we heard about. We've also seen good growth from new clients. In fact, they've grown 30% year over year in this quarter. We've definitely seen good growth from our European business as well. I think very, very strong growth there for almost 6 quarters now. And this particular quarter, it was in the direct business almost 27-28% on a YY basis. So I think it's been all-rounded, well conceived, and broad-based growth.
All right, fair point. Broad-based growth is what you're seeing, Nitin. So in that case, what sort of revenue outlook do you have for the remainder of this year? This morning we were speaking to Coforge, and they believe 6% constant currency growth this year is possible. You did it in the second quarter. What about the next 2 quarters?
Yes, I think 2 things to note there. Firstly, we've already crossed our pre-pandemic peak revenue in Q2. We crossed it by almost 7 million in this quarter. Previous peak was in Q4 of 20. We also called out for the fact that our growth will recover from sequential basis Q2 onwards, and we even in Q1, which was the crisis quarter, we actually didn't decline on a YOY basis. So I think if we continue the trajectory, you can definitely look at the current growth rates being sustained on a YOY basis.
The year, what should that number look like?
Probably mid to high single digits.
Mid to high single digits. All right. The problem in the business is this DXC business. Now, that's gradually been coming down, and that's really the only part of these numbers that we've been looking at, whether it's this quarter or a couple of quarters earlier as well. Tell us what's going on there. What is the minimum revenue commitment that you're getting from them? And when does this expire? By September 21, right? So isn't that a risk?
So I think, we've obviously over the last 6 quarters, we've been working fairly diligently on making sure that we grow everything else around it. And I think we've been fairly successful in not letting those declines, especially in the last couple of quarters, derail the overall company momentum. I think we have another 4 quarters, roughly 200 million of MRC that is still left to be consumed. Obviously, there will be some seasonal variability and quarterly volatility, but broadly, I think that gives us a good guideline to September 21. And I think from that point onwards, it will become like any other client for us because, in every customer, that we compete in and do business in, we have to show value and earn business. And that's how we think this will play out as well post September 21. So we're not really worried about it per se. We believe that we have good positioning, good set of capabilities, and we'll continue to find ways to work with every customer, including them.
Right, interesting there. If you could tell us a little about your margins, because that was one of the things that stood out this quarter as well, 16.1%, that was a sequential recovery. You have a guided band of 15.5 to 16.5. Which end of this band do you think you'll end this year in? And would you change the band itself?
No, I think so far we've not changed the band because the philosophy that we decided to follow early on in the year, especially as we saw the crisis being hit and the opportunity to actually accelerate some of our deals and deal wins with customers. The primary philosophy was that we'll try to make sure that we can maximize the growth potential that exists in the market today, given just the fact that we have a competency-led growth model where a lot of our digital transformation capabilities are in high demand right now. So we prioritize growth over margin expansion. We've held the margins steady. Of course, they've improved 40 bips QOQ. But we do expect to operate in the same band because we are taking a lot of the margin operating leverage that we are getting from the current environment and reinvesting it back in either competency build-up or sales expansion. And in many cases, we're also using some of that to invest for ramp up of the deals that we've been winning over the last 2 quarters.
All right, Nitin, thanks so much for stopping by. The numbers have been looking good. You're sounding rather confident as well. High single-digit revenue growth. Wish you the best for the second half of this year. But clearly, the business besides DXC has been doing pretty well. Well, on that note, though, we'll slip into a short break. You come back, we'll continue our focus on markets. We'll also get in a couple of other managements on the other side. Don't go anywhere.